And welcome out to the Halftime Report presented by Tackle Trading. It is August 21st, 2019. We have myself, we have Coach Noah, and that's all we need. Isn't that right, Noah?
Oh, absolutely. We are here. We're going to have a great day. I'm excited to be here. Just had an awesome morning doing the Traders Lounge. We talked a little bit about trade adjustments and repairs, and talked about rolling options and things of that nature. Pretty interesting market. Rallying back overnight, gaining back what it gave up late at session close yesterday. So
man, it's been just literally down candle, up candle, down candle, up candle, down candle, up candle. It's whipping back and forth constantly, and I assume the Traders Lounge this morning had to do some adjustments just on that alone. Just hey, we adjusted yesterday this way, but now we need to adjust this way.
Well, it's a pretty good little whipsaw. And again, one of those situations where, if in doubt, sit it out if you don't have positions on. I'm kind of being patient, waiting to put on new stuff. But also you've got some pretty clear lines in the sand. You got a resistance point, some moving averages it needs to clear before I feel full-blown bullish. And of course, there's a battle line. I think it's kind of.
Where do you put those lines?
Well, I'm looking at the S&P, and I think right now, whether you draw that line with a fat trend line or a small, price zone line, doesn't matter. I think you've got to absolutely break above the 20. And then that 50 period moving average is a big demarcation line, and that's up around 29.48. And then you got the resistance zone in that ballpark. And one of the things that I've been looking at is you get down into an intraday chart, and you back it out to go long term, 20 days, 1 hour, shows you some support resistance zones. And it's really, I think it's got to break this 29.42 ballpark. It's really got to take out that resistance that's established intraday. You go back a little bit more history, you'll see you got some old support zones in there as well. So if I back that out and look at 30 days, I think that ought to get the old support zones in there. If it does break out above 29.42, it's got some resistance out there at 29.68, which again, if you can see the intraday cup and handle forming here, right there. You see that?
Yep, I like it. It's pretty clear.
So that's a clear little cup and handle. You got a pretty clear line in the sand right there. If it breaks out, it's this next zone out here that becomes, something that the traders will have to contend with. And of course you have overhead resistance as well. But I think that's the key zone I'm watching right now. And the market, has been thinking about taking out that zone. It coincides with these old highs from back in April. And it's not too far off those old highs. It's about the same ballpark as you have clear back in last September. And so, this is a big price zone for the market, big, battlefield for the Bulls and the Bears. And you're seeing it's like a shoving match, just back and forth, up one day, down the next, up one day. So a couple of Twitter people I follow, say they put out some pretty funny stuff there. It's like one of them, it's like, hey, if you don't like where the market is today, just wait a day and you'll be back to where.
So, no, I personally, I'm neutral until I need it to be above 29.50, or I needed to break that 200. Other than that, I'm just cash flowing right now. I have not taken a directional trade this week.
Yep. Got to keep those deltas, at this point in time, delta's neutral. If you're, managing positions, remember your first loss is your best loss. You can't be afraid to rip off the Band-Aids if things are running against you. And again, this kind of a market is very news driven. I'm not sure if the economic reports are what driving this, or if it's Twitter, tweets coming out saying that,
Public service announcement, everyone. Twitter is not real life.
It's not real life, but I guarantee you it's pushing the markets around when you're
one tweet can change the news cycle in a heartbeat. Which actually I was surprised we even have this much movement right now today, because when I woke up this morning, I was expecting the markets to kind of be flat, just doji until after the FOMC meeting minutes came out. But we've already had movement throughout the day, and now if you break down the intraday chart, now is when you're kind of starting to see a little bit of more. Just, hey, we're not sure what we're going to do. Probably just going to teeter off until we get those meeting minutes. And the reason we need to look for those, and I want to get into this a little bit, is, why do we care about what the meeting's minutes were for a meeting that we know the decision that happened 2 weeks ago?
Well, and again, it's not an official policy statement, but it's one of those things like anytime the feds talk, people listen. And I think all eyes are on Jackson Hole, and normally Jackson Hole, you don't see policy come out of there. You might get a leak or two, but of statements, but it hasn't been a big market mover. And as I've studied over the last several years, it's just kind of they get together, they talk shop, but does it actually move the markets?
Yeah, from everything that I'm expecting is, because, which I also think there's the news tries, big argument hubbub. Trump's been, crapping on the Fed for quite a while now, saying they raised too aggressively and they need to cut more aggressively. That's not even new news. He did that again recently. But whenever like the talk started coming out that said like, oh, the Fed's looking to cut rates a half a point, I never saw that news. And to me, I just saw it as the media was pushing, saying, hey, Fed, you should. And they only cut a quarter point. And as a matter of fact, there were no votes for a half point. So what I'm curious to see is what the talks were within the meeting itself to see were there talks about a half point? And did they have any conversation internally on what the future is going to look like? Because what Jerome Powell said afterwards and what we're hearing now, like there's a gap, and that gap keeps widening on what we're hearing, what we're seeing, and what's happening. So I'm
I keep an eye on the CME Group's Fed Watch. And right now, again, the next official rate statement doesn't come out until the 18th of September. And at this point in time, 98% probability of a quarter point cut. So current rate is, 200 to 225. They're talking about 98% probability of it going 175 to 200. There's a small chance it stays the same. So I don't see them speculating on a bigger than expected rate cut.
See, that's one of the things. Because the last time Powell spoke, he said he wasn't looking at the next meeting to have a cut, but the following one might. But now we have the Fed Watch tool that says 98% chance the next meeting will have a cut.
Yep. So there's
a gap between what's heard, what's said, and what's believed.
Well, and that's, people believe what they want to believe. I mean, things are going great with China was the tweet, I think, that drove the market up. And that's pretty vague. What kinds of things are going great?
Wait, was it like a copy paste tweet? Like
probably.
Just retweet something I said back in January. Let's just do that again.
Yeah, I'm sure that's how that goes.
Those actually come out, let's see, in about an hour and 19 minutes is when those meeting minutes come out. So if you guys have never looked at them and just to be curious, just take a look at them, read through it. It doesn't take too long. And
what you were saying what you were saying earlier, I thought was really pertinent as you get into and you look at what to expect ahead of it, like an FOMC meeting. I expect sideways price movement until they announce, and then whatever, if they do say something of interest, the market may move up or it may move down, but it tends to get quiet up until they talk. So you'll expect, I usually expect prices to just kind of oscillate on a 5 to 15 minute chart until they do say something. And then again, these are not policy statements. These are just meeting minutes. But if they come out and they sound dovish, the market will rally. If they sound hawkish, the market will sell off.
Exactly. Yeah. And
yeah.
Steve, to answer your question, there's a couple different places. You can get it through any like economic calendar place will bring you to the website, but I believe it's actually the government website. Don't know off the top of my head.
You've got a Federal Reserve website that actually puts out their meeting minutes and you can go read those. But you can just watch the the news dealio here. You can go just change your edit your,
you can find it.
switch your gadgets. They move things around on me so many times. Switch your gadget over to the news, and then you'll see like the news headlines pop out right here. And so as news comes out, boom, a lot of the news is noise, but right as the Feds announce, their meeting minutes will come out and there'll be links in those news items, those news stories.
There you go. That's a faster way to do it than going online.
Well, you can also watch your major media outlets as well, and you'll see the meeting minutes, and it's one thing I think people hear what they want to hear out of those sometimes, and it's a lot of it's up for interpretation.
They nitpick the one or two words that they were looking for, and those become the two words that are in every
They
headline.
used to say things like, I mean, I kid you not, this has been years and years and years, but they're like, if Ben Bernanke puts his briefcase on the left, that means that they're going to be dovish. And if he puts his briefcase on the right, that means they're going to be hawkish. It's a secret. And then they'll be like, what was her name? Maria Bartolome. I can't remember. I don't remember how to pronounce her name. They're like, if she's wearing, pearls, that means the feds are going to cut rates. You're just like, oh, come on.
You know what? I might, next time that there's going to be an announcement, I might look at for things like that, and I might make a game out of it. All right, guys, which side is he going to set his brief? Which is he going to look left more often, look right more often?
Yeah, Bartiromo. That's it, Adam. Thanks for helping me out with that. But again, I mean, most of it, they're you got to remember, like when you're watching news outlets, like I used to watch CNBC a lot and like Bloomberg, and I'd sit and kind of stay glued to the economic news. But then it occurred to me that they're just selling ad airtime, that they're just talking and talking and talking while they sell airtime. And so they're going to put on point, counterpoint. They never really come to a conclusion. None of the news they really provide. It's all fear mongering speculation.
Yep.
And they're just selling airtime. And so I'm just like, I turned it off. And so that's why I just focus on economic data and what the market responses are. Like, you don't have to predict. You just have to be watchful, keep your eye on it, be ready to pull the trigger, set up your stops and things in advance. So if the market moves one way or the other, you can get triggered in, triggered out. And again, the goal is to not be reactionary and chasing after the news. And, you can anticipate. Predict is not the right word for trading. I don't think when you start to try to predict things, that's when you I think get your ego involved. But if you try to anticipate,
I have a crystal ball. No, I just have a crystal ball that I nicely look over it and it tells me what's going to happen, and then I just do that.
Well, I've been thinking more and more about doing trading segments involving things like crystal balls, magic 8 balls, Ouija boards. Which stock should we pick? Like,
I have a Ouija board on there. I like it.
Well, it's got to be as good as some of the stuff out there. So, because
we'd have to make sure that when we did it, we disclaimer it like, this is satire. We are not serious. Do not do this. What the Magic 8 Ball says, please don't just go out and blindly buy whatever. I'm not even gonna say a stock.
Well, and that's true. Adam says always trade the secondary move, not the press release, because you get a knee-jerk reaction.
Yes, that's exactly right.
You'll see a pop rally drop or whatever. You'll see it run one way or the other. And then that's true for real headline news. It's the real news is on page 2. Headline news is always a distraction. And so you got to keep your eye on, and I, look for those economic reports and data, and I really am data driven. So I look at those things and, I do see some concerns. I do see some global economic slowdown. The data hasn't been as great. We got to watch what's coming out of Europe this week. And again, the Fed, they're not going to give us a decision, but if they allude to the decision, things get priced in. So
I love that, Jimbo.
Next level premiums. We're going to have to charge you extra, Jimbo, for that service, for sure. That'll be another $50. I love it. But market's been interesting today. This morning we were talking about some of the other, candidates and movers out there. A lot of the indices are looking the same as you pop out and you look at the NASDAQ. I think the NASDAQ's probably the strongest of the bunch. I think it's got the best looking breakout scenario. It's right up against the 50 now, already above the 20. The Dow's
I've always real quick just
softer.
on that. Yeah. NASDAQ, when it is going to move, it's always been the faster moving, and it's because it's tech heavy. The whole idea behind when tech gets going, it's automation, it moves.
Mm-hmm.
And so those companies, you can have money flowing into them very, very quickly, faster than your retailers, your industrials, your base material. It's just because those companies, if they take a hit or a down week retracement, they're not going to recover as quickly. Whereas tech, it's boom, they're back to business like nothing happened.
Well, and I like what Swin says here in the chat. Set up those OCO trades, set up those brackets, preset it, cover both moves. You can do the K trade. But you can also, I think it's really tough if you get a fast moving market off of news to be quick enough on your reaction to place trades. And I try to do that from time to time where I try to manually manage things, but automating it, you don't have to be, Johnny on the spot with your trigger finger ready. you can
So the
automate that.
only thing that I will caution you on this, and it was something that Matt and I have talked about, just like from what Adam said, the secondary move. One of the things, and it's not as bad in necessarily the stock market, the futures market can have it, and the Forex market can have it, is during these meetings, these releases, the bid ask will increase. So you might get a terrible fill rate on your OCO.
Yeah,
The actual fill rate itself might decrease your profits or even make it harder to break even.
agreed.
So be cautious with that if you're going to do the OCO trades. But yeah, sorry, we get off on a tangent again. Let's keep working through the markets.
Paraphrasing, and it's good. Paraphrasing, parroting. If you're listening to the right stuff, those are the things you want to do. Automate those things. So it takes the emotion out of it. It takes the need to be, in the right place at the right time. You don't have to be present to win or exit trades. And again, this is, I expected a little bit more quietness out of the market so far today. And we're getting a little bit of oscillation on that. Down there on the smaller time frame, I got 15 minutes there set up. And again, NASDAQ's kind of hovering above its old resistance.
And it's starting to do just like I said at the beginning. It's just going to kind of go sideways until those minutes come out.
Yep. So keep an eye on that. Dow was a little softer out of the bunch. It's if you look at it, it's still down below its moving averages. The 20 period still riding down. It's got a resistance zone. And then the Russell, if you take a look at that, I know a lot of the Condor folks keep an eye on that. That's still down below the 200 period moving average. So, your small mid caps on that Russell 2000 are not being as responsive or bullish, but they still have the exact same chart pattern. They're just down below that 200. So that gives me a little bit more of a bearish bias on those. And then, you keep an eye on some of your other major indices out there. You keep an eye on your dollar index, and the dollar, I am expecting the dollar to break out here, but this is kind of an interesting thing. Rate cut normally would be bad for currency, but in this case, everybody else has already got their rates cut. So if we cut too, I still think we're ahead of the crowd. And again, that will, I think, actually bolster the dollar a little bit, oddly enough. I'm expecting to see the dollar testing 99 soon is my general expectation, not a prediction, just what I'm anticipating based off of what I see on the chart pattern and just understanding where the dollar is being, how it's playing out in global competition and the currency war, so to speak.
Absolutely. Yeah. I've just been waiting. I said it yesterday, and it's still true. And actually all last week, like I didn't actually have many, actually I had none last week. I had one yesterday finally trigger in the Forex market. It's been just very calm, no clear signals. So I'm on the sidelines.
Yep. Absolutely.
Again,
cash.
Actually, that was probably the hardest lesson for me to learn as a trader in my growth was the patience aspect of it.
Oh,
the
yeah.
thought of literally sitting and checking my account for 2 weeks and not placing a trade was the hardest thing for me to learn because I always felt like I needed to be doing something. I didn't want my money just to sit. It's like, but sometimes it's better for your money to sit than you to enter a bad trade.
Cash is a position. Sometimes the best thing to do is sit on your hands. So you're not clicking that mouse too much. And you gotta avoid that itchy trader finger and impulse.
Oh, it is. And that's exactly what it is. It's an itchy
trade.
Fortino, Cody, did you make Forex trades from the report coming out on the CAD this morning? The CAD I triggered on the British pound. So go check that one out.
US dollar, Canadian dollar down a little bit. What did you do? What's the
not that one? Check yeah, that one. That one triggered for me.
There you go. Kind of a bearish scenario there.
Yep.
A little slow on momentum. Whoops, don't mean that.
Yeah, so kind of watching that one intraday because as right there you can see that 20. I really needed to get past that 20, but if it doesn't, I'm watching it on the intraday to simply get out pretty quickly. So that's the only one but I'm liking that pattern. So
not bad
at all. Let's go ahead and move on to oil. And then after oil, I want to talk about two very interesting earnings releases, and that's Target and Lowe's. So we'll get to those here in a second. But oil, I see nothing with oil.
Well, my seasonal expectation for oil this time of year is always bearish. Consumption tapers off after July. and you know you're down below the 200 period moving average. It's relatively neutral. It's in between support resistance. Yesterday, Matt and Tim were talking about, you know, the consolidation triangle on it, where it's coming down and it's heading up at the same time. Well, okay, I'll get back to you on that. I don't personally expect to break out on oil. I actually expect it to break down, and I expect it to head down towards 50. And that $50 benchmark on oil is a tough number, because if it goes below 50, your oil producing companies they have to start shutting off pumps.
Yep.
Because the
outweigh
operation costs and, you know, refining costs and everything else, you know, they're not making money below $50 a barrel. So, but my seasonal expectation for oil, have you ever looked at a seasonal chart on oil? Let me switch my layout real quick and show you the seasonal scenario on that. So I'm going to go switch my chart mode to seasonality and load up 20 years worth of data. And you can see that red line there, that's the seasonal expectation for oil. So you get into September, what does oil do from the end of August on? Tends to drop clear through the rest of December. That's 20 years of data. Now that doesn't predict a dang thing. This is just like saying it. No, and there's zero prediction value in the seasonal aspect, other than the fact that it's 20 years of data, and 20 years of data tell you that historically it is more bearish in the fall and that fourth quarter. So you get that, you know, bearish outlook on that. And that might be an indication of how institutions treat it seasonally, but it also might be weighed down by 1 or 2 years of sell off. Like these averages of 20 years, you know, you get a couple of years where you have heavy selling in oil that happens in the fourth quarter, and that's going to weight the entire average. So, but it is something I expect. I'm always bullish on energy and oil in the spring from February through May. I'm always looking at it. Peak consumptions 4th of July. And then again, it tapers off and drops. And so, you know, that's a good expectation. And then, you know, while we're at it here, you take a look at the SPX on that, and you see when you get those lines separated, you got to go down and go to manual and just highlight the red line, so you can see what the seasonal expectation is. We'll get that drawing tool. And as you look at
guys,
that,
take notes here. This is Noah's years of experience he's handing out in 10 minutes, where he's back tested all this stuff.
This is your seasonal cycle for the market. It does awesome through May. There's an old market saying, sell in May, go away. Summer months get oscillating. June usually stinks. July is usually awesome. August is pretty flat. September and October tend to be sell-offs. And then fourth quarter is where it rallies. But those September and October downs, those are weighted by the couple years where you see bear markets hit. And there's a reason for that. October 15th, you'll notice the bottom kicks in right there on the October 15th ballpark. That's your corporate tax, you know, deadline. And this is kind of where your seasonal expectation. If they've got a good bullish outlook for the fourth quarter, you'll see the market stay strong. But if you've got, you know, a couple of institutions decide that they don't think the fourth quarter is going to be that hot, they start pulling money. That's what starts to lead to significant sell-offs. And if you go back and look at major market crashes and corrections, they do tend to happen in the fall. They tend to happen, you know, they talk about the biggest crashes being in like October. Well, that's just when they realized it crashed. It usually starts a little bit in September. So I'm still kind of neutral on the market. I still think that if the Feds are cutting rates, it's going to be a tough thing to fight. That should make asset classes go higher. But then I look at things like valuations, and I'm a big part of me is a perma bear, and that's a problem I have as a trader sometimes, is because there's part of me that's a perma bear. And, I look at valuations like
market goes up more often than down. So
it does. And so people always laugh at the perma bears, but nobody ever laughs at the perma bulls. But the valuations on the market, with the earnings coming out, you got companies like, Target and Lowe's, they had interesting outcomes. But I look at something like the Schiller PE ratio, and you see it at 29, and it was at 29 back on Black Tuesday in 1929. It's been higher during the .com era, but the crash of 2007, the valuations were lower. They were like 27. We're at 29 on the Schiller PE ratio, and anything over 30 is considered overvalued according to the price to earnings ratio metrics. And it's been higher recently. So we've actually seen earnings improve and bringing that Schiller PE down a little bit. But a part of that's because they did stock buybacks. And that they improve their bottom line and their earnings reports when they do those kinds of buybacks. So it's interesting to see how that stuff plays out.
Let me be the contrarian here and say, or ask you, how do you think this works with the inflation of the dollar itself? So the actual price part being a little bit inflated, wouldn't that historic
the Shiller PE ratio is also known as the CAPE ratio, which is the cyclically adjusted price to earnings ratio. And they do try to account for inflation in that.
Okay.
How efficiently do they account for inflation? Always a question.
Because if $30 is the or $30 is the ratio, but that's also mathematically off of a dollar amount, but the dollar is inflating, then wouldn't that ratio number might get higher to where maybe you could get above 30?
They do cyclically adjust. I think the big question in my mind is, you look back historically, the mean's been around 15. And, when you look at like old school fundamental analysis, like a PE ratio under 30 is desirable. Under 20 is really desirable. If you get down under 15, then you got a really well-valued company, because the price of the stock compared to the money they make is not out of sight. But I think it's also changing expectations, where it's that people are seeking return. Well, where do you get it right now? Bonds?
Maybe.
Savings accounts?
No.
Okay. Your choices are
yes, I get my 0.001% back when they're lending it out 10 to 1 and charging people 6% interest. That's a great deal for me. No, it's a fantastic deal for the banks.
Right. And so in search for return, people really are kind of pigeonholed into real estate and paper assets.
Yep.
And I think that the expectation is shifted, where, okay, I'm willing to pay a little bit more for it. And the best way I can describe a PE ratio is here's the way I describe it. Think about a jack in the box, little handle crank on the side. When you crank the little wheel, a dollar bill pops out. And let's say you got 2 jack in the boxes. And, this one over here also, a little dollar bill pops out when you crank the jack in the box. And those jack in the boxes, this one costs $15 and this one costs $29. Well, they both produce $1 of earnings. Which one's a better value? $15 is a better price. It's a better price tag to pay for the asset. Well, now people, if their expectations being shifted, well, you got to put $29 in to get $1 out. That's what a kind of a price to earnings ratio gives you, is a kind of a ballpark of what kind of money you got to put in to get money out. And the expectation now is, well, you got to put in, $29 to get a buck out, buck of earnings out, so to speak. Well, okay. If it's still a better rate of return than bonds, then people might be interested in doing it. If it's a better rate of return than, other things, people will still be attracted to those paper assets. So
you just reminded me of, and I can't find it. So I read this book a while back called The Big Con. It's just kind of like a compilation of stories of some of the history's greatest con men. And that reminded me, there was one, of course, it could never happen today, but before airplanes and everything, the ship between Europe and the United States, the time it would take to make that trip, we're talking about a month or so for just to make that trip. And what he would do is he built this box that would print a $100 bill, but the downside was it only printed $100 bill every hour. So what he would do is he would take this box and he'd show it to someone, and he'd have it stacked with $500-600. So we're talking like 6 hours worth. And it would sit there and print as he's sitting there talking to him for like 3 hours, just printing money. So then he'd sell him this box for thousands of dollars, get off the boat right as they're arriving, and he's gone. 3 or 4 hours go by, the box stops printing money.
It's a charlatan. The goose that lays the golden egg is never.
Yeah. So that's what your Jack in the Box metaphor just reminded me of, that story.
Well, yeah, interesting.
Fun fact for you guys. And I'll look back in this book and see if I can figure out his name. But anyways, let's go ahead and take a look at Target earnings. Okay. I really did love that historic seasonality, by the way.
Well, I put a little joke out on Twitter today. Shop at Target and save the U.S. economy from going into deep recession.
I put out and of course it's not an original meme. I put out the one that said, I accidentally wore a red shirt to Target today. Long story short, I'm covering for Debbie this weekend.
Yes, that'll happen to you every time. Thanks, Deb. That's a good looking pop out in a break. Now their market maker move was priced at $6, 6.5, 685 or so, I think, when I looked at it yesterday. And so they got a gap up here that is now exceeding, what do you got there? 17 points. Much bigger move than expected and priced in, 3 times the expectation. This is one where, surprise, surprise, Target's earnings, pretty solid there. And they did actually have a nice beat. They came in at what? I think it was 12 cents above expectations.
They had, I had it pulled up. They
17, 18 cents, somewhere in there.
Earnings of $1.82 per share with revenue of 18.4 billion, where they were only expected to come out with $1.61 per share. So what's that, 21 cents up above what they're expecting. And they were only expecting a revenue of 18.3 billion. So they literally did $100 million more in sales than was expected in the second quarter. So they're up revenue 3.6%. And
is that a sign of strength in retail?
Possibly, or at least cheap retail.
Well, it's interesting. I've noticed that they're not rebranding, but they're restructuring a lot of their stores, and they're shifting some of the retail focus.
And that's something else Target is doing. Their online presence and their like delivery to your car. They're doing a lot more of that too. I mean, right now, if I want something online that isn't in Hawaii, a lot of times that Amazon won't ship it out here, eBay won't ship it out here, Walmart, but Target will. So they're even trying to go the extra mile of expanding where they're willing to ship things to you.
Well, that's the price you pay for living in paradise, $9 gallons of milk, and you can get them at Target.
Which fun fact, this day in history was when Hawaii was founded back in joined the United States as a state. As a state. Back 50th state to join the Union back in 1960.
Well, aloha and mahalo. But again, nice move on Target. And I watched when I see Target, I always think to go double check some of the competitors like Walmart, and Walmart's still showing some signs of selling out there near resistance. And they had a good response to their earnings, popped up, and it's kind of stagnated out there at their resistance point. We've talked about Home Depot yesterday. They popped and they're out there testing their head. They're poking their head up above resistance, and you might see a run out of that. But then Lowe's comes out, has a good report. And this also gapped bigger than expected, but it's selling off after that gap. So it kind of, again, good report, nice outcome, big response. They beat their earnings by a few pennies as well, and I didn't read their report.
Let's see what they did. They were expecting, or they reported earnings of $2.15 a share and revenue of $21 billion. They were expected $2 a share, so 15-cent beat, and a revenue of 21 billion. So their revenue was exactly where it was expected, which is also one of the reasons they didn't get as big of a pop. And then they're still on consensus year over year. So their forward guidance, they say that they're going to match what was expected. Whereas Target had to up their forward-looking guidance, basically saying, we're going to do way better than expected moving forward because of, what we just had. Lowe's is like, we're still on track. So,
well, and didn't Home Depot actually lower their guidance?
I don't remember. Did Home Depot lower their guidance?
They got gapped up. They beat earnings, and I think they lowered their guidance a little bit. But it's, again, overall, I mean, those might be signs of strength in the economy. Those types of retailers. But then I watched the rest of the retail sector and got zero confidence in the rest of the retail sector.
The thing also gapped right into a resistance level at 110.
Funny how that works, isn't it?
Yeah.
So gaps in resistance. You ever want to see something interesting, drop where your fibs are. And a lot of times, I don't know if it's going to work. We're going to find out. I'm going to go grab a little drawing tool.
Days that Tim's not here, we can talk all fib, all we want.
Well, all fib, all you want. But okay, there's your range, and it gapped up to your 61.8% ballpark. It'll usually gap to your fibs. And that coincides with your resistance. So that's pretty much the same ballpark. You can draw magic lines on a chart. I love Fibonacci's. They're fun. You draw enough of them on your chart, you can say whatever you want about them. So it is.
I like how you were trying to match earnings and you matched the exact previous resistance though.
That's the reason that support and resistance kind of form where they do. Yeah, is there those Fibonacci's do have some, some I don't know about predictive value, but that's where the algorithms are written. A lot of
That's
them.
what we can call our show. Something like futures with Fibonacci's or something. And like, and then we
Fibonacci's
grab the
and friends.
Fibonacci's and friends with the Ouija boards. And
If you just take this divining rod right here.
when they look for the water when they like cross.
Yep. Fact. True. So I think those are interesting outlooks on the market. And again, you watch how that's playing out. Again, I think the biggest thing that Target and Walmart have done well is they're adapting their online shipping model. And now even I noticed Home Depot and stuff has got a lot stronger delivery service. You can order stuff online and have it delivered in some places same day. And, they actually do have, a little bit of delivery going on out there as well. So as people change their habits, I think it's important that these retailers are just adapting to it. And again, your specialty retailers, particularly the ones that you see in your malls across America, I think are still struggling and still having a hard time. And I don't expect that to change because again, people's behaviors have changed. So
Yeah.
interesting outlook.
When you really think about it, there's a difference between when you're going to the store and you're already shopping at it and you happen to see something extra you weren't looking for. Versus if you're like, hey, I need this particular item, I want to order a scarf from wherever. Well, you don't just jump in your car and drive to the local mall and start looking for it. You just get online and say, oh, okay. Oh, they can deliver it to me in 2 days and it's only $20. Sure. I'll take it.
Yeah. Well, doesn't Amazon try to do that with your shopping cart every time? Hey, you might also like this item and this item and this item. Hey, there's Mark. How you doing, Mark? GE still, again, coming up.
They're just awful.
No, they're whistleblower news. I've been a little skeptical about that whistleblower news, because I think they had motivated reasoning.
You think they were short going into it?
Well, the people who made the report specifically were not, but they're in the shares from the hedge fund who is. So they get to share on the profits from the hedge fund. They independently funded their own report. And I think that there at some point in time, that's got to be some market manipulation.
So here's my question then, because I can understand, doing it nefariously, where they just go short and immediately announce that they don't like it and then they collect the profit. Okay, where do you draw the line between doing it in nefarious fashion versus you're doing the research, realizing there's something wrong, so you naturally start going short, and then as time's going on and you get more and more data, that's when you just come out and you say, hey, like this is what we found. So at what point is it just happenstance?
Good question. Well, I mean,
there's nefarious.
Well, I think you have to have some sort of SEC regulation in there where, whistleblowers cannot have a vested financial interest in the outcome. Because otherwise you'll get people, I'll blow with, if that was the case, you could just go do something like, hey, this company's, they're lying to you, whatever. And all of a sudden their stock drops. If you buying positions beforehand, that's dirty pool.
Here's my breaking news to short the stock. Beyond Meat's food does not taste good.
I've heard that before, but why would I be surprised?
Right.
So I guess, here's the thing. So I always think about Bill Ackman, right? He large, obviously, we know him, huge investor, large funds. And I just watched a documentary on this. I think it was on Netflix. It was really good. It was talking about how he was constantly stating that he has this really big short out there. And he's shorting it. He's like $1 billion short this company, but I'm not going to tell you. And he just kept saying how short he was some mysterious company. And then he came out and said it was Herbalife. And everybody's like, you're just doing this for nefarious reasons. So that was their counter argument because he was basically calling it a pyramid scheme. They were getting more money off of trying to recruit people than they were actually selling their shakes.
You mean like a direct marketing company most often does?
Yeah.
All right. Okay. I'm just saying.
Yeah, I know that's exactly. Yeah. Whenever you find a company that they say, hey, we're going to sell this product, but if you find 5 people to help you sell this product and they find 5 people, then it's like, wait, so you're not worried about selling product. You're worried about recruiting people to sell product.
I live in Utah and it's the Mecca for multi-level marketing companies. I mean, you name the company, odds are their headquarters are somewhere around the Provo region of the state. And there's a lot of them out there. There's New Skin, there's Zango, there's Herbalife, there's a whole bunch of those companies. And again, I think direct marketing sales is actually a reasonably good business model especially for entrepreneurs. But that's the expectation. You have to understand that, it's a direct reseller business, and it is about recruiting. And if they don't have a good product, then it is a pyramid scheme, right? But whether or not it's a pyramid scheme, that there's a fine line in there. And again, most of those direct selling companies, they do relatively well.
Well, I guess it all just goes to the point of, okay, if he thought it was a pyramid scheme and that's why he's shorting it, okay, that's why he's shorting it. And Herbalife took it the other way, and they accused him. They said, hey, you're only calling us a pyramid scheme because you're short it. So is it a correlation or a causation, and which one is nefarious, and how do you draw the line?
Look at Disney. I mean, they're not a pyramid scheme. They just make you buy $17 churros. So, they get your kids all excited about going to Disneyland. They say it's the happiest place on earth, but have you ever been there and not seen a toddler crying? I mean, it is a rough place to take your kids someday.
Honestly, Disney has me crying right now, because right now Disney and Sony aren't in agreement, and they might have to rip Spider-Man out of the I can't even get my words out. I hate it. Okay, so here's I was reading about it. What had happened was Sony actually owns the rights to Spider-Man. Disney owns the Marvel universe, so there's a split there. So what they've done in the past is Disney has fronted all the costs to produce the movies, and then they pick up 5% of, or they first recoup all their costs before profit, then they pick up 5% profit. Sony takes the rest. So Sony actually has a better deal there. Like, beautiful. Disney came to them this time when it was time to re-up the contract, and they said, hey, let's do a 50-50 cost upfront split, and then a 50-50 recoup and a 50-50 profit. And Sony's like, no. And it's like, yes, you had a beautiful deal to begin with, Sony, but come on, let's do this 50-50. Disney spent all this money building out the Marvel universe, huge. Come on, quit being greedy. Take your 50% and go make some money. And that's Cody Mackey attacking Sony.
Well, and Disney had their little whistleblowing news come out, and they didn't even respond to it. It shook it off like Taylor Swift did. And it's just boom. I mean, it did not react at all. And I think that might be because of what you said with GE. GE came out and they countered and said, no, they're exaggerated claims, blah, blah, blah. Did not respond at all. I mean, staying actually looks like a decent little bottom there at 132. Now, if it breaks, you could see some selling pressure down into that gap, but it's holding its own right there. Not a question about that.
Well, we're pushing up against the clock, guys. Mark, you popped in to be the person to take us out.
Double booking of shows. I guess that is my double booking, and I'm giving
I love you, man.
I will pass off to you and then let you send us out, guys. Noah, you and I had a lot of fun here. A lot of little Easter eggs we dropped too. With that, Mark, I'm passing it on to you.
All right, so got 2 shows tonight. We have Mind of a Trader at 7:30 Eastern, where Greg Holmes. Listen, one of the most common questions we get: how do you learn software? Questions about software. I mean, you're learning how to trade, but you also have to simultaneously learn the software. Greg Holmes is going to go over on Mind of a Trader tonight some tips, tools, techniques, education on interactive broker software. So if you've ever been interested, Interactive Brokers is a platform I use personally. We don't recommend software platforms, but that's the one I use, and a lot of people like it for low commissions. 7:30 Eastern, he's going to go over teaching interactive broker software. So if you have software questions, if you're looking for a new platform or new to trading, definitely a nice broad education. We're opening that up to everyone, pro members and non-pro members alike. And an email will be going out to our database today, letting you know the link on that. And then at 8:30, Noah is going to be teaching the first step system mastermind group. So if you've completed the step system, you'll receive an email with the room location where you can log on. That starts at 8:30 tonight. So double show tonight. Interactive Brokers teaching lesson at 7:30 for everyone. Step System Mastermind Group at 8:30.
Yep.
And everyone, have a wonderful week. We are so happy to have you here to be part of the Tackle Trading, whether you're a pro member or not. I mean, we just have the best time interacting with our members, and we're very lucky to have such a wonderful community. So I, send out just, with those thoughts of gratitude, and everyone have a great day.
Well, and if you haven't yet, like, subscribe, share, tell your friends about it, get them in that step system, because the mastermind group tonight is going to be awesome. We're just going to be all diving into the details. You've been through the training. We're going to be there to field questions and do practical application of the step system and apply those rules and actually talk about, it's a beautiful little swing trading system. And I think it's a great place for traders to start. Trading simple stock. You can trade it with options. We're going to talk about how to do those things. And again, how to apply what you learn in the training. So we look forward to see you guys there. We will slay some dragons for sure.
Take care, everyone. Have a wonderful day.